When we talk about liquidity, we're talking about how easily money can flow through the economy. High liquidity usually means there's more money available for spending and investing. This is where M2 comes in. M2 is a measure of the money supply that includes cash, checking accounts, and some savings accounts. Investors keep a close eye on M2 because it can influence asset prices. When M2 increases, it often leads to more money flowing into stocks, bonds, and even cryptocurrencies like Bitcoin. This increased demand can drive up prices, making investors happy. Conversely, when M2 shrinks, markets can become less liquid, and prices may fall. Right now, many analysts believe that M2 is poised to increase. What's interesting is that this expected rise isn't directly tied to the Federal Reserve cutting interest rates or aggressively expanding its balance sheet, which are the typical tools used to increase liquidity. So where is this extra liquidity coming from? Let's investigate. Please consider subscribing to our channel. Traditionally, the Federal Reserve has a few key levers to control liquidity. They can lower interest rates, encouraging borrowing and spending. They can also buy assets like government bonds, injecting money directly into the financial system. However, neither of these methods are the primary drivers of the anticipated M2 growth. Instead, we're seeing liquidity increase through less conventional means. One factor is central bank lending programs. These programs, often introduced during times of economic stress, provide loans to banks and other financial institutions. These loans increase the amount of money banks have available to lend, boosting the money supply. Regulatory changes also play a role. Sometimes regulators loosen rules on banks, making it easier for them to lend money. This can free up capital and increase liquidity. Finally, we can't underestimate the behavior of depositors. During uncertain times, people and businesses might hold on to cash or move money into safer, more liquid assets. As they shift their money around, it can impact overall liquidity levels. To understand how these factors actually increase M2, we need to talk about the fractional reserve banking system. This system is how banks create new money. Here's how it works. When you deposit money into a bank, the bank doesn't just hold on to it all. They are required to keep a certain percentage as reserves, but they can lend out the rest. Let's say you deposit $100, and the reserve requirement is 10%. The bank keeps $10 in reserve and lends out the other $90. The person who receives that $90 loan can then deposit it back into a bank, and the process repeats. This cycle of lending and depositing creates new money in the system, multiplying the initial deposit many times over. This process is a key driver of M2 growth. The potential increase in M2 raises important questions about its impact on the economy. Some critics argue that increasing the money supply disproportionately benefits the wealthy. They point out that easy money often flows into assets like stocks and real estate, which are primarily owned by the wealthy. This can exacerbate wealth inequality. Another concern is inflation. When more money chases the same amount of goods and services, prices tend to rise. This is a key consideration for policymakers trying to balance economic growth with price stability. The potential rise in M2 without the usual Fed actions presents a fascinating case study. It highlights the complex interplay of central bank policies, regulations, and individual behavior in shaping the financial landscape. As we move forward, it's crucial to understand both the potential benefits and risks of these alternative methods of expanding liquidity. The debate about their long-term impact on the economy, wealth distribution, and inflation is far from over. Thank you for watching.